Now, there are two other terms that come up in bankruptcy that I want to go over briefly. So the first one is called reorganization, and the second one is called liquidation. Okay, so liquidation is pretty simple. This is where you are selling assets, and selling assets is not a good thing. You might think, well, it's generating cash, but obviously the assets were supposed to be generating revenue. It could have been a division, and that's gone now. Reorganization is where you change the capital structure. Okay, and the capital structure would be like your debt-to-equity ratio. So the debt-to-equity ratio has changed. There's two ways you could do that. You could either issue equity, okay, which is not a great thing to do, or not even a possibility when you're close to bankruptcy. But more realistically, you could convert debt to equity, and that would change your debt to equity ratio. And that's pretty common. Like, you do have banks, bondholders will convert to equity if they think they'll have a higher chance of getting their money back. Okay, now what if you don't? What's the order of payments in bankruptcy? Now, this could be different in the US, but in Canada, the way it works is the first people that get paid are the bankruptcy trustees. If they did not get paid first, they wouldn't bother doing it, because they would just be billing a bankrupt companies of no value. Next is wages and salaries of the employees that are due. And then the government wants your taxes. Things like rent would be after that. And if there are any, you could have employee lawsuits that are outstanding or that have been successful but just haven't been paid out yet. And then after that, you get debt. Okay, so any debt holders will get paid after that. Then you get the preferred shares. And then after that, last is you get common shares. And essentially, everyone knows that common shares are going to get nothing in bankruptcy. What do the debt holders get? It depends, but I'd say less than 10% would be a good ballpark. So if you are a debt holder and the company went bankrupt, probably 90% is gone, if not 100. Now, preferred shareholders are ahead of common shareholders, but what's the point? If debt is only going to get 10%, then preferred shareholders will get nothing as well. So that's not a good spot to be in. Even though they're ahead of common, they may feel good about themselves, but it's not going to help. Now let's do an example of a scenario. This is it's not a real life example, but it's from the text, so it's useful for your exam. An example of quantifying distress costs and how you would pick a capital structure. Even though life doesn't work this way, they gave us a very set out estimates for cost of equity and cost of debt. And what they're saying is a company's got $1 million of EBIT, earnings before interest and taxes, and then they're expecting a tax rate of 30%. And they know that the debt and cost of equity is in the table below. So if you have no debt, then the cost of debt is 10% and cost of equity is 12%. If you have $1 million of debt, then cost of debt goes up to 10.4 and equity goes to 12.67. Now, they're giving us those numbers, but it does make sense. As you add debt, it should get more expensive, both for debt and for equity. And what they want you to calculate is what's the optimal capital structure. And essentially, the only way we could do that on this is we're going to do a scenario for each one. What is the EBIT in each scenario? So scenario A, we have no debt. Okay, the value of the company is going to be the EBIT minus the interest times 1 minus the tax rate divided by the cost of equity. So this is essentially the value of the equity that we're calculating. And if we're told that the value of the EBIT is $1 million and there's no interest because there's no debt, 1 minus a tax rate of 30%, and the cost of equity is given as 12. Okay, so we have total value of the company is $5.83 million. Okay, so I'll write that here, 583 million. And that's the value of the equity and the value of the company in this case. Okay, so in the case of 1 million of debt, we're going to say the value of the company is equal to the value of the equity plus the value of the debt. And we're given the value of the debt. The value of the company, so the value of the debt is going to be $1 million. Okay, so I'll just write it, that's the debt. The value of the company is going to be EBIT of 1 million minus the interest. Now in this case we have $1 million of debt, and the interest on that $1 million is going to be done at 10.4%. Okay, so 1 million times 10.4 would be 104,000 times 1 minus the tax rate. And we divide that by the cost of equity, which has gone up now to 1267. Okay, and we get a value of $5.95 million. Okay, so it's gone up. It was at 583, went up slightly to 595. You can see the benefits of the debt here. So we'll say 5.95 million. And if we keep doing this, I won't do it for, but it's the same concept that you keep rerunning it at each level. What you will find is that the value of the company will continue to go up, and then eventually it'll just stop at this level. So if I plug the last two in, I won't go through the detailed calculation, but it goes up to 601, and then it goes up to, or down to 5.93 billion. Okay, so this is only solved not by a formula, but really by iteration. So this is the optimal debt level. And so in this scenario, if all of these assumptions were to hold true, then what you would say is the company should be taking $2 million in debt, and that'll maximize the value of the firm.